On the Barron's Roundtable, my colleagues Ben Levisohn, Carleton English, and Jack Hough. So let's begin, Carleton, with the traditional 60-40 investment portfolio. It's a classic approach to investing. In stocks, 60%. In bonds, 40%. The stocks give you the growth. The bonds act as a shock absorber. But this model came into question when bond yields were suddenly at zero. Then yields skyrocketed, and the Wall Street Journal reported that the 60-40 portfolio is on track for its worst performance since 1937. But that does not mean it's a bad idea.
Right. I mean, you don't want to say that the 60-40 portfolio is dead. I know a lot of people have, but you have
Google
to
it. It's all over the
everywhere. So you have to think, when you are building a portfolio, you are doing it for the long term. What does that mean? Some years, everything's going to work. Some years, nothing's going to work. Some years, you're going to have a little bit of this and a little bit of that, and you just hope that you kind of come out ahead. So yes, we are looking at a very challenging year for 60-40. That mix through the middle of November was down about 15%, roughly on par with the drop in the S&P 500 over the same period. You had bonds enter a bear market this year. But again, it doesn't mean that the system is dead. It's just, yes, it's a challenging year. And you don't want to minimize that, but I wouldn't advise that anyone change drastically.
Sure. Right now, stocks are cheaper and bonds are actually giving you some yield, 4.5% or so.
Yeah, and that's something that, over the last 15 years was basically never happening. So, on the bond side of the portfolio, as you point out, you are getting that 4% yield. If we do head into a recessionary environment, bond portfolios have usually held up, at least when we're talking about treasuries, the flight to safety. And also for someone coming in now, you're coming in at a lower point.
What do you do? 60-40, right? Not for everyone. So how do you tell what's the right mix for you? 70-30, what have you? Everyone says age. How much of it should be your wealth, what you're using the money for? For context, I'm 85 years old, which in the U.S. makes me eligible to run for president in 12 years, so I might need some campaign cash.
Well, for that, I would say go into Bitcoin. No, but seriously, with the 60-40, the thinking was always you use that kind of bond allocation with your age. So if you're 40 years old, 40% bond allocation. But you really have to think about, okay, what are your needs? That's what it's about with portfolio construction. It's what do you need and when do you need it? And that's going to be the determining factor of how much in assets do you want to have in riskier ventures versus more conservative ones based on, are you looking to buy a house? Are you paying tuition? What's your net worth? How much risk can you handle?
You got to buy like 16 more chainsaws, I know, Jack, so keep some cash on hand for that.
A lot of trees.
Jack, let's start with Ben, sorry. Let's start with the 60%. That's your stock portfolio. Where do you put that money right now in the stock market?
Well, the good thing is that stocks are so much lower that you really can't go wrong if you start investing in the long term right now. I do think that we're entering a point where we want to be investing in stocks, not in sectors. And we had this long period where tech stocks just outperformed everything, or tech adjacent stocks. Then we had this year where really energy was the only thing that went up. But we want to be looking at individual stocks because it's going to be an environment where good managers are going to do well and other managers not so well. And that means looking for funds that are maybe core funds, not value, not growth, but a mix of everything. Things like perhaps the T. Rowe Price Dividend Growth, that's PRDGX, or the American Funds Washington Mutual, AWSHX. But an easy way to do it would just be to look at an equal-weighted S&P 500 ETF versus the S&P 500, which would be RSP.
And I would be remiss to not point out that just a simple, straightforward index fund, Vanguard Total Market Index, has beaten about 80% of actively managed funds over the long term. Jack, take us to the 40. How do we invest in bonds?
The exciting part, you're saving it for me, the bonds. Right,
Have a cup of coffee.
4% thereabouts on treasuries, maybe 5 and change on high-grade corporate bonds. And it's tempting to think there's always some kind of investment salesman around saying, oh, wait a second, you could do a lot better on preferred stocks. You could do a lot better on, this or that, or junk bonds, this or that asset class. The purpose of this portion of the portfolio is to keep your money safe. I would say keep it boring. When you're talking about things like REITs, other income-producing assets, I would think of those as part of the stock portion of the portfolio. I don't want to hear about anyone's math model about how these investments aren't correlated with stocks. You're reducing your overall correlation. Correlations all change when the market comes to times of stress. Risky stuff acts like stocks, not what it's acted like in the past. If you can get 4 to 5% in the safe part of your portfolio, that's much better than you were getting a couple of years ago. And don't worry if the latest print on inflation is 7% and change. That's a backward-looking figure also. The next year, I don't know what inflation next year will bring, but I would guess it's not going to be 7%. I have to check my notes for next year's inflation, yeah.
Okay, so how does an investor get access to these pretty safe, straightforward 4 or 5% yielding bonds?
I mean, if for most investors, you can buy a fund, right? BND, that's the ticker for Vanguard Total Bond Market. It's a one-stop shop for bonds. There are a lot of ETFs like that. If you want to buy some treasuries on auction and just buy the corporate bonds in an ETF, there's LQD, another ETF. If you're talking about millions of dollars putting in a bonds, hire someone to do it for you. You have enough money to properly diversify a bond portfolio.
By buying individual bonds.
Yep.